I'd like to estimate a valuation model for Google, and by that I mean a true discounted cash flow valuation model, not one that prices by analogy using price-earnings multiples or anything like that. So I need to develop a growth scenario and then perform a discounted cash flow analysis on it. And on top of it, I want to run Monte Carlo simulations over a scenario in which I specify error rates so that I get a range of plausible valuations for Google. Okay, let's get started and move to the required tab. Here I need to specify how many distinct growth periods I want. I want a fairly detailed model, so I'm going to pick 5 distinct growth periods, each of which can have its own growth rate, its own discount rate, and its own length. Then I need to specify whether growth happens between or within periods. Within periods means it's a continuous growth model, so growth happens as specified later from year to year at a specified rate. And that's the model I want here. And the last thing for the model structure that I need to specify is whether I want this to be a finite model, meaning the last period has a specified length, or whether I want to do a classic terminal value model where the last period runs to infinity, and that's what I'm going to choose here for simplicity. Next, I have to specify the growth rates for the 5 periods. And I'm going to make it fairly simple. I'm going to start with some growth rate, and I'm going to talk about what that growth rate is in a second. And I'm going to descend that into terminal growth. And terminal growth, pretty good assumption is that it's going to grow with the economy. So at about 2.5 to 3% for the terminal rate. Now the question is, with what rate do I want to start for Google? Google has been growing tremendously. The question is, at what rate is it going to grow in the future? And a good way to approach this is to look at what are they investing, what amount of cash are they investing, and what return do they typically generate on capital invested. Now the return on capital invested for Google is about 25%. So I'm going to use that. And last year they've been investing something on the order of 34 or 34.5 billion dollars. This should generate additional profits of $8.5 billion at the 25% return on invested capital. And these $8.5 billion over 67 billion in free cash flows last year should be something on the order of $12.7%. So I'm going to use 12.7% for my starting growth rate. I know I want the last growth rate to be 2.5, so I need to fill in the gaps here for 3 additional growth periods. And I'm going to descend in steps of 3, I think. Does that get us there? Let's use 10, 7.5, 5, and 2.5. And then I'm going to say, but I don't know whether I'm right or wrong. So I'm going to specify some errors around these rates. And for the upper one, for the highest growth rate in the near future, I'm going to take, because it's fairly large, I'm going to say I could be off by 1.5% each direction. Then for the next 3, I'm going to choose 1, and for the last one, I'm going to choose 0.5%. So it could be 3%, it could be 2%, but in the middle, on average, I think it's going to be 2.5%. Then as for period discount rates, people make a lot of fuzz about weighted average cost of capitals and betas and so on. I'm more with Charlie Munger and Warren Buffett that this is a lot of gobbledygook. I want a return that is at least in line with the market. And for me as the investor, it's about the opportunity cost. That's not about what Google can generate. It's for me as the investor who's thinking about his opportunity costs, and that's an investment in the market. So I'm going to say that I want to discount this at a rate of 10%. You could choose any other rate, but I think this is plausible. It's, by the way, also what Buffett and Munger, or rather Buffett, who's doing the discounted cash flow analyses, seems to be doing. And then again, I'm going to allow myself for some error rate, saying that maybe 10 isn't it. Maybe it's 9 or maybe it's 11, so I'm going to give myself an error range of 1% around it, the 10% discount rate. And now this is the really tricky question, is how long do I think each of these 5 growth periods above is going to be? That is virtually impossible to judge. Google has had a tremendous record of prolonged growth over high growth over an extended period of time. And yet I want to be conservative, so I'm going to say maybe they can do this 3, 4, 5, and 6 years each for the 4 non-terminal periods. For the terminal period with growth of 2.5%, I don't need to specify a length because it's going to run to infinity by assumption. And again, I'm going to say that I don't know how accurate I am with the length of these growth periods, and I'm going to give myself 1 year of wiggle room in either direction for the finite growth periods. Okay? And with this, I've already specified enough information to get a fair, unadjusted multiple for Google. And we can switch to the Execute tab. This would put the fair, unadjusted multiple at 27.3. To get to a valuation, we need to give the model additional inputs, which I specify here on the Optionals tab. Google's current free cash flow is 67, or was last year $67 billion. Its current market capitalization is somewhere around 1.4 trillion, and we will specify this in millions also to be on the same order of magnitude. So let's say it's 1,430 billion dollars. And we need to account for that Google holds a lot of cash. So basically, we're buying a company that has a thick wallet, and we can take this wallet that we buy with the $1,430 billion and spend it on something else. And their net cash might be on the order of $111 billion. None of the other things we need to talk about here because they don't apply. So we'll switch right to the Results and Execution tab. So this gives us a multiple of 28.9, a valuation of $1,939 billion, and a potential upside of 35.6% over a valuation of $1.43 trillion that Google might currently have. Again, I might now use the opportunity to run simulations. Remember that on the Required tab, I specified error ranges, such as here, here, and up here, for the growth rate, the discount rate, and the period lengths, because I said, I wasn't sure how long it really was. I wasn't sure whether it was really the right discount rate, and I wasn't sure whether the growth rates would pan out the way I estimated them on average. So what I can do now is, within the error ranges that I specified, run 100,000 Monte Carlo simulations and see what distribution over valuations results from this. What that's going to tell me is what range might valuations fall into and with what probability, and it's also going to give me a probability of a profitable investment, that is, that the valuation is going to lie above the current market value of $1,430 billion for Google. Just a little bit more waiting time because it has to draw a lot of random numbers here, and here the results come. What it generates is a histogram with the valuations. This little thing here shows the quantiles, and it shows 4 different sets of quantiles. It shows the min-max range, it shows the 95% confidence interval, it shows the interquartile range, and it shows the median. Now the median is the point that splits the data in half, and 50% of values lie above the median and 50% below. The interquartile range from 25% to the 75th percent quantile contains 50% of the data, and 25% of the data fall above the 75th percentile, and 25% of the data fall below the 25th percentile. The confidence interval, the 95% confidence interval, is very dear to statisticians. It states the probability in which, or the range in which 95% of the data fall. We therefore can be certain that the true mean given our assumptions falls within that range 95% of the times, so to speak. And then the min-max range bounds the range of the observed data. And we get 3 sets of values that correspond to the table above. We get the fair multiple, we get the fair value, and a percent downside upside. We see that the fair multiple is anywhere in the range from 21.7 to 40.7 given our assumptions. 95% of the times it falls between 24.8 and 34. 50% of the time, the interquartile range, it falls between 27.4 and 30.7, and our median estimate, point estimate for the median, is 28.9 for the fair multiple. That translates to fair valuations in the range of $1,452.9 billion to $2,724.9 billion given our assumptions. That translates to a range of the upside from 1.6% to 90.6%, and a likelihood of a negative scenario of a loss of 0%, meaning that all of our scenarios, all of the simulated instantiation of our growth scenario, result in a positive outcome. So now we have to ask ourselves, do we believe the assumptions that we put in the first place, or do we think these are too optimistic? If they're too optimistic, we have to adjust them downwards and run this whole thing again. But if we think they're reasonable, then we would find that Google is a buy at its current valuation. Thank you very much.